Here is what dispatchers get wrong about the factoring question. They treat it as a moral debate. One camp says factoring is a tax on weak operators. The other says only fools wait 30 days for money they could have today. Both camps are wrong, because both camps skip the math. Factoring is not a personality test, and Net-30 is not a badge of honor. They are two different ways to finance the gap between when your truck delivers and when the broker actually cuts the check. One of those ways has a visible fee printed on every invoice. The other has a fee that is completely invisible until you sit down and calculate the carrying cost of your accounts receivable. Most new carriers never run that calculation, so they argue about factoring the way people argue about politics, with strong feelings and no spreadsheet. The right question is not whether factoring is good or bad. The right question is what the cost of capital is on your specific operation right now, what your working capital cushion looks like, and what your broker mix actually pays. Once you answer those three questions, the decision stops being a debate and starts being arithmetic. Here is the failure mode that wipes out new authorities in their first 6 months. A carrier launches with $8,000 in the bank, refuses to factor on principal, and books 2 solid loads in week 1 at $2,000 each. Fuel for those 2 loads runs about $1,300. Maintenance reserve, insurance installment, and the truck payment eat another $2,200. By the end of week 2, the bank account is sitting at about $3,000, and the carrier has $4,000 of invoices outstanding to brokers who are paying Net-30. Week 3, a tire goes. Week 4, a broker kicks back an invoice because the lumper receipt was missing and resets the 30-day clock. By day 35, that carrier is using a personal credit card at 22% interest to buy fuel for a load that pays in another 30 days. The carrying cost of refusing to factor was not zero. It was a credit card balance that compounds faster than the freight margin can pay it down. That is not a factoring problem. That is a working capital problem dressed up as a principle. Here's the right approach. Run the actual numbers before you sign anything. Start with your weekly revenue target. Multiply by 4.5 to get your steady-state accounts receivable float. A carrier doing $20,000 a week is carrying roughly $90,000 in unpaid invoices at any moment. Then ask where that $90,000 comes from. If it comes from a business credit line at 12%, your carrying cost is about $900 a month, or 1.1% of revenue. If it comes from personal credit cards at 22%, you are paying over $1,600 a month, or 2% of revenue, and you are one slow broker away from a missed minimum payment. Compare that to a factoring fee of 3%, which on the same revenue is about $600 a week in fees, but zero working capital strain. Now layer in the variability. Net-30 is not really 30 days. It is 28 days when the broker is good, 45 days when the broker is slow, and 60 days when the broker is in trouble. Factoring smooths that curve to 2 business days every time. The honest answer for most new authorities in months 1 through 18 is that factoring is liquidity insurance, and the fee is the premium. After month 18, when you have real broker payment data and real reserves, you revisit the decision with actual numbers instead of opinions. This is also where the back office quietly decides whether your margin survives the year. Factoring fees are the visible line item, but they are not the only one. Your MCS 150 biennial update has to be filed on schedule or your authority gets flagged. Your BOC 3 process agent designation has to stay current in every state you cross. Your UCR has to renew in the fall. Your IFTA quarterly filing has to match your IRP apportioned miles. Your 2290 heavy vehicle use tax is due by the end of August. Your drug and alcohol consortium has to keep you compliant for random testing. Your MVR has to pull annually for every driver. Your CSA score has to be monitored, so a bad inspection does not turn into an insurance non-renewal. Cypress Authority Services runs all of that as a direct build operation, which means we are not reselling someone else's compliance platform with a markup stacked on top. We hold the registrations, we file the forms, we monitor the scores. That matters here because the same carrier who is bleeding 2% on credit card interest is usually also bleeding 3 or 4% on stacked compliance markups they never priced out. Factoring is one decision. Compliance overhead is another. Treat both the same way. Run the numbers. Here is the single action to take this week. Pull your last 60 days of settled invoices and build a 4-column spreadsheet. Column 1, the broker. Column 2, the invoice date. Column 3, the payment received date. Column 4, the days between. Then calculate the average and the standard deviation. If your average is under 32 days and your standard deviation is under 5, your broker mix is reliable, and you can start thinking about whether factoring still earns its fee. If your average is over 35, or your standard deviation is over 10, your broker mix is volatile, and the factoring fee is buying you predictability that you cannot replicate any other way. Then go look at your bank balance and ask whether you could survive a 45-day gap if your two largest brokers both went slow at the same time. If the answer is no, the decision is made for you, and there is no shame in it. The carriers who survive year one are not the ones with the strongest opinions about factoring. They are the ones who treat it as a math problem, solve it with their own numbers, and revisit it every 12 months.